Hey all, this is Akshara Menon from Famous Bazaar, and I'm thrilled to welcome you for the 8th episode of our webinar series, The Alternates Universe. Right now, the markets are facing precedent lows, creating both challenges and hidden opportunities. This webinar is a perfect chance to uncover the emerging value zones in midcaps to navigate the market corrections with confidence. So today's topic is catching the falling knife, emerging values in zones in midcaps. Couldn't be more relevant. How do you turn market corrections into opportunities rather than pitfalls? That's exactly what we're going to uncover today. Finding mid caps amid the market turbulence, spotting the sectoral shifts, and that could unlock value, managing risks effectively in volatile times, and understanding the outlook on the mid caps earnings and valuations. So, take us through this insightful discussion. We have our esteemed speaker. Meet Mr. Madanagopal Ramu. As the head of equities and fund manager at Sundaram Alternates, Madanagopal brings over 18 years of experience in Indian financial markets. He currently manages AUM over 3,500 crores, leveraging his deep expertise in navigating mid-cap opportunities and market cycles. His sharp insights on earnings growth, valuations, and market trends make him a key voice in this space. Moderating the conversation is Arjun G. Nagarajan. Arjun serves as the Chief Economist and Communications Manager at Sundaram Mutual. With over 12 years of experience in equity markets, his expertise has shaped high-level economic discussions, including the Niti Aayog meetings as a pre-budget consultation with the Prime Minister of India. With advanced degrees in economics and finance from University of Madras and University of Exeter, UK, Arjun brings over a strong macroeconomic perspective to today's discussion. And this is going to be a very insightful and interactive session. So stay tuned and ask me questions and put your questions on the Q&A box. And I encourage not to ask stock-specific questions. Before we start, let me give a disclaimer. Securities and investments are subjected to market risk, and there is no assurance or guarantee that object of the investments will be achieved. Yeah. So over to you, sir.
Thanks a lot. Thanks a lot, Akshara. And like you said, what a perfect day to start and have this conversation. So as we speak in 2025, the Nifty is corrected by roughly around, let's say, 8%, mid cap by around 18, and small cap by around 22. So the perfect couple of quotes for today is that of the veteran investor Warren Buffett, where he says, "Be fearful when others are greedy, and greedy when others are fearful." Another quote that came to my mind was that of Rothschild, where he's credited to have said something to the effect, he said, "The time to buy is when there's blood in the streets, even if that blood is your own." Now, finally, to sort of quote these quote mania that I've sort of started, veteran investor Benjamin Graham, where he said, "Purchase stocks like you purchase groceries, not like you buy perfume." So I guess today's markets are probably to be seen as discount sales, like likes you see on Amazon and Flipkart, rather than anything else. So quite a heavy evening for many today. So in lighter vein, reintroducing Madan here, Akshara, in our own very Doctor Strange from the Marvel series, who is sort of closest to crystal ball gazing the markets for us and investors today. Hi, Madan. Lovely
Hi,
to have you here.
Hi, Arjun. Always lovely to talk to you.
Pleasure to host you. A lot of questions here to demystify the markets here. So I'll keep my questions sort of short and crisp. So let me just sort of jump right in. I'll start off with the first question. So, like during demonetization, everybody was an economist. In these markets, everybody is a chartist and a technical analyst of sorts. So, having said that, many market gurus are also heard mentioning that the momentum of the markets is sort of broken. So, two questions for you here. How do we interpret these statements about the momentum of market being broken? And more importantly, how do you see the market currently?
So thanks, Arjun. You started off with some big quotes made by veteran investors. There is one quote that Mr. Warren Buffett says, "Only when the tide is coming back, you will see wolves swimming naked." So we are in that period where a lot of as you said, everybody became a fund manager, and a lot of people used to suggest me which stock to buy. So the last 2-3 years, when I meet investors, they give me more ideas, because that was the breadth of the stocks that were performing, and there is a reason why it happened, right? I think post COVID, money came in and flows started coming through, capital liquidity improved globally. India benefited from one more leg because China was not doing well. So within the emerging market, India got a lot more money. And seeing all this, it followed by domestic money coming through also. And the domestic money, everything flow into the mid and small cap space. And you can see the mid and small cap sectors, fund managers who were managing 3,000, 4,000 crore are all managing now 30,000 crore plus sort of money. So there is a lot of money that has flown. The sector has done well. A part of it has to do with the earnings growth that we witnessed in that space because we benefited as a country from the COVID recovery phase. And there was capacity constraint that got created in China, which India filled in. Therefore, our exports did for a while very well compared to what was expected. That helped the mid cap and small cap. A lot of these export stories were in mid and small cap space. So that they benefited. And followed by which we also benefited because post-Ukraine war coming to some sort of settlement, the commodity prices crashed, and India still had a reasonable economic growth rate. Therefore, earnings was doing well even till 2023 end. But we were highlighting even that period that the revenue growth has already started to moderate. And India's revenue growth was touching in single digit even in 2023 itself. But 2023, the earnings growth was still very good. And the flows continued on the back of the good earnings growth. We started warning the investor. But actually speaking, market did not show any signs of falling even till last December, right? So it was still mid and small cap which was trying to recover in every fall. So flows as a function on what kind of impact it can have in the mid and small cap space is a very big space to study for behavioral science in itself. And in my opinion, I'll try to keep it very simple. If the mid and small cap where the liquidity is so small, if that space the flows kind of multiply the AUM by close to 5 to 6 times in a short period of time, you can easily put that phrase into it. There is a greed which is there. There is no fear. There is a greed, and that cannot be ruled out. And that greed was going on till December. Obviously, you should expect some correction. Now, whether the greed has been broken, whether the fear has come in, I would try to say that the fear is still not set in, obviously, but we are seeing early signs of people calling and asking us what to do. One thing that has happened is last period when this mid cap got broken down, and you have to understand, go back and understand what happens with mid cap. Generally, mid cap, due to the liquidity and the flows getting attracted in a short period, has a tendency versus Nifty. Its valuation expands from -5% or 10% in the lower level to almost like 25-30% premium. It happened in 2014, it happened in 2017, it happened in 2022, 21 also, and recently it has happened in 24 as well. So every 3 to 4 year time period, you will see this attraction happening to mid caps and valuation jumping. So this time, end of December, we saw the valuation premium of mid cap was as high as even 40%, and nobody really bothered about it because the flows were continuing and it was helping. And anybody who took a different view was getting battered because the market was going up very fast. We were conscious about it. We were having mid and small cap names in our site, but we took cash call very quickly and we converted into cash. Today we are sitting at a 30% cash for our investors. I think there is no other better investment today than being in cash is what I feel with the kind of correction last 1 week also we are seeing. The momentum is definitely looks like there is a bit of broken from the point that the FII outflow would have caused some bit of an anxiety. The flow-driven market is over. The earnings-driven market is beginning. That's what I will say. The difference that will come in the next 2-3 years. It gone are days where you will just talk about narratives and then hope stories, and then can drive the stock prices by 100% or so in a very short period because of flows, because of a few brokers liking it. I think those days are gone. Now we are entering a phase where if you buy and if you are confident that even if it is a mid cap stock or even if it is a small cap stock, if its earnings is going to be good, then those stocks will get backed and they will create you good opportunity to make money. So it's slowly getting into from a passive and diversified style oriented market towards concentrated, focused, bottom up sort of a market. We have talked about it a lot of time, but it really happens only when the flows momentum gets broken. Domestic flows momentum is not yet broken, but given what is happening right now, you can expect at some point of time it will mellow down, if not get negative. But FIIs have created this momentum that got broken. Now market will sit back and look for. So the flows are not expected to come back in a hurry. So that's another point that you need to keep in mind. So, but these are the markets where the people have to have a different approach towards the market. Don't look at your computers. You will make mistake. If you see a falling stock, you will think as if something is wrong about the stock. As much as these stocks without any substance went up, in this market, the stocks will fall without any substance. So in this period, your focus should be on earnings. Your happiness should come whether the stock is delivering your earnings. If your stock is delivering on the earnings and if it is still falling, you should be happy because you can allocate more money to that stock. It's a period where you have to sit and reassess your portfolio completely. I said this to my team that probably we had a New Year get together. We said to the team, we have to take this phrase very seriously, wherein I am not able to recall who said this. He says that to be a winner on a continuous basis, every year you have to die and get up as a new person. So we were talking about this in our New Year get together that we need to die and then rethink completely new for us to approach the market in a different way. Every investor who's in this forum also, you have to just erase all whatever style that helped you to make money in the last 2 years. You have to erase that and then rethink about your portfolio. The best way to rethink about your portfolio is orient towards sectors and stocks where there is a visible growth. Don't panic there and get out of all the stocks. Today, the correction has been very sharp and it was very fast. Last time, the correction happened over 3 years and it was 25% correction. This time, we saw that 25% correction in midcap in 2 months time period. Therefore, and that is why with a lot of, although you will always fear people coming on and saying, don't catch the falling knife, right? That's a general phrase. We wanted to keep this discussion, the title that catch the falling knife, because there is an indiscriminate selling. People are selling stocks without paying attention to earnings. And that is why we feel that this topic is very apt at this moment. And even today, I was happy to see some stocks falling because I was feeling that, okay, I have cash now. Okay, let them fall. Another 2 weeks, if it continues, we are going to get some of the stocks at a real good bargain. We can increase the weight of them or enter them. That is what we are planning to. It is obviously a market where you need to reassess, but it is a correction that has already happened. So to really think about exiting the market, it's not a right strategy. But the momentum of the market has got shifted. The style that worked last 2 years are not going to help you in the next 2 years. A passive and diversified market is moving to a focused and concentrated market.
Fair enough. Fair enough. Well, that you sort of preempted another question that I was going to ask you about this catching the falling knife. So I'll just reiterate and just tell me if I understood this right. So you've seen mid and small caps correct by nearly 18 to 23% or so this since the start of this year. Your portfolios don't seem to be skewed towards large cap. A lot of people keep talking about how large cap looks cheap and mid and small cap still look expensive. So your portfolio seemed more balanced and not skewed towards large cap. So can I then say that you are looking at mid and small caps very seriously, and you, like you mentioned, you will be looking at more opportunities going ahead to get on to more in mid and small caps? And one cue, if you can give investors as to how should they look at the mid and small cap space from a point of view of positioning, from a point of view of time horizon of investing. You mentioned earnings growth. If there are more layers that you can add to that earnings growth narrative and how they should look at the mid and small cap space, given that your portfolios are fairly balanced and it does not really have an undue large cap skew.
Yeah. So I'll start with large caps. So what is the problem about large caps? Large caps valuation is not an issue.
Uh,
I don't think it was never an issue because large caps did not rally only at the first place. For the large caps, the biggest issue is earnings growth. Structurally, large caps contribution to the overall profits of the India Inc. or listed companies has been coming down. What does it say? It is representing less of the growing part of the country. The sectors that are there in large cap, I can take some of the sectors like metals, commodities, oil and gas. Within healthcare also, it is generic pharma. It is not Indian pharma or Indian hospitals or healthcare system. Within consumer, it is mostly staples. Consumer discretionary has just started to get into the index. Within the manufacturing, it is only L&T. There is huge amount of universe beyond L&T in manufacturing and the infrastructure and capital goods and all these areas. I think the problem with Nifty 50 doesn't represent the growing part of the country at all. So to that extent, if somebody is saying that get into Nifty right now, it is more of a short-term approach to protect your money rather than really growing the money. Now we can approach this in two ways. You can do that. I'm fine. But today Nifty is also falling. The reason is because Nifty is also not cheap. Nifty's long-term average PE, 10-year average PE is around 18 times. It is still at 19 times. So you can argue for a 5% correction. Imagine Nifty's Q3 earnings growth was 5%. Excluding oil, which had a decline, it is around 7-8% something. 7-8%, and then you have a situation of US Treasury yield at 5%. And depreciation of rupee, I don't need to mention. So where is the margin of safety for Nifty? Look at from an international investor, what will he get? And when people say that Nifty will be bought, I wonder how it is. Banks, they form 30% of the Nifty. They are growing less than 10%. Staples, pharma companies within the Nifty. Pharma companies within Nifty, excluding Sun Pharma, people are talking about flat revenue, flat profit growth for next 2-3 years because one blockbuster drug which was helping them to grow is now starting to fall. And 3-4 companies in the Nifty are all got benefited in that. So generic pharma followed by oil and gas, metals. Given the global slowdown, it's not heading anywhere. I say these as low PE, low growth sectors. They form 40% of the total index. And okay, this is mathematical way of telling why you should not look at the Nifty PE and then expect midcap PE to come there. And then I have a point on midcap also, which I will say. If you look at the Nifty PE has 40% of the sectors where the PE is less than 12 times, and they are slow growth. And you can also include other 20% which is slow growth but high PE. Literally, you can say 60-70% of the Nifty is either slow growth or high PE slow growth. This is not something where you will make big money in if you are going to invest in the next 3-year perspective. Rather, I would say you have cash. You raised cash. If you have raised cash, it's good. But if you don't have cash, you reallocate the portfolio within the mid and small cap and some of the large cap. Have a multi-cap approach, not restrict to one particular cap curve, but reduce the number of stocks that you have. Move more towards the performers. And if you have identified these performers and you have got out of some of the underperformers in a quick time, in the next say 1 week or so, just wait for the market. It will going to throw you good opportunity. By Q4, I think there will be a reasonable amount of recovery in the economy, and I would like to hear your view also. I feel that government has taken a lot of effort to bring some growth back because they were shocked seeing 5.5% sort of a growth. Now they are approaching, they are cutting the repo rate. They are now giving a lot more flexibility to banks for NBFC lending. which ensures that money goes to the lower end of the income within the society, and they are also trying to see how they can help through fiscal policies like taxation, that they can help some consumption to come back, because globally things are not happening. Therefore, private capex cannot be a way to recover the economy. So they are saying, okay, can consumption can consumption recover? And I think so. It can happen, because a lot of our sectors are sitting at 80% capacity utilization, in my opinion. So if you give a kind of a breather for growth, then the private capex in itself start getting activated. So I think that's a good move, in my opinion. Whether it is enough, it's a very big debate, because 1 lakh crore is something you can debate whether it is enough. But to bring back some growth in an otherwise the economy which was losing a momentum is something which government has taken its effort, and I think private sector is not as poor as it was in FI before COVID, right? Their balance sheet was in a bad condition. Now their balance sheets are in very good condition. The corporate leverage is at the lowest point at this point of time. So if there will be a need for capex, they can do it. And I think a lot of these positive factors are still there. They can raise money even with this correction. Still, the market cap to GDP is very high, which comes to save you whenever there is a crisis, economic crisis, credit quality issues. I think all this get addressed. This is certain very good thing about Indian economy. I think market got oversold on certain themes and certain things by which they market, particularly when people ask me about mid cap. I'll come to that part, but just to complete on the nifty large cap, I think earnings is a major issue, and people just giving a call that move to the large caps, move to the large caps. I am surprised about it. It can be a short-term call, but it cannot be a real long-term call, because Nifty's earnings growth is not likely to be, because of the sector that it represents majorly, cannot be more than 10%. When it comes to mid-cap, as you said, valuation is high. But you have to understand mid-cap in a little more detail, Arjun. Mid-cap is not one single animal. Okay, to put it another way, if you look at mid-cap, the way I look at mid-cap is like a railway junction with two platforms. So the junction, like probably you can take a mid of the country, like Bhopal's railway junction. It has two sides of a platform. One side of the junction is as companies which are moving from small cap to mid cap to large cap are also standing in that junction. They are in the transition, but they are in the junction, but they are growing fast. They are run by managements which are very growth oriented. They have in sectors which are growing fast, and the company's balance sheet is decent. They can invest into the business because it is growing, and this is because India's per capita income is growing. There are spaces where the growth is still very active and opportunities there, and government has gone into this pushing for domestic manufacturing, so it is helping some sectors there. So all this also are part of the mid caps. Some of them are richly valued, but a lot of them are fairly valued also, I would say. We have another set of stocks where these stocks have come to mid cap from large cap. They are heading south. These are trains which are heading south. They are also there in the mid cap. If you take the mid cap 100, Nifty 100, it is equally distributed. It is equally distributed between growth stocks and equally distributed between underperforming stocks, which are underperformers for a long period. Last 2 years, Arjun, the second bucket was the best performing bucket. Because generally, whenever there is a money flowing into the market, mean reversion happens. The mean reversion is very easy to happen based on narrative and short-term cyclical factors. You saw PSUs doing really well. Now everybody sitting and questioning PSU's earnings. Nothing changed, except that the narrative got broken. When you asked about what broke in the momentum, these are the narratives which have got broken. There is this famous saying, right? Time is a friend of good business. Time is an enemy of bad business. What is the meaning? If the business is not very sound, does not have any competitive advantage, the management cannot keep surprising you beyond a point, or cannot keep delivering you growth beyond a point. They will get benefited because of certain short-term cyclical factors. Once that is behind them, they will be clueless on what they can do to bring back growth. But there are managements, good businesses, good business models, where the time is their friend. In the short term, due to certain cyclical factor, they may get impacted. It can be valuation. The stocks can get impacted because of valuation, or if it is earnings, they might get impacted because of a sudden increase in the dollar or sudden increase in the raw material cost. But if they are good business, then time is their friend, because within 2 3 years they will show the real earnings, and then the valuation will come back, and those stocks would have outperformed to you. So I think the bucket which within the mid cap, which is to do with a lot more noise and narratives and all this, they were the best performers in the last 2 years. So now their momentum is broken. So now going forward in Nifty, if you are going to own 100 stocks in Nifty mid cap, I'm talking about, if you are going to own 100 stocks, 150 stocks, the tail will keep hurting you. This is just the beginning. This is just the beginning. Next 2 years, you will see overall Nifty's mid caps index return might still struggle. But within that, 30 40 stocks might give you good return. The remaining 100 stocks might drag your return. In Nifty mid cap 150, we were doing this analysis. So we feel that there is a reasonable amount of earnings growth. Even in Q3, Arjun, the number of stocks which delivered more than 25% growth in Nifty mid cap was around 35 stocks. And if you take more than 15% earnings growth, it was close to 60 stocks. So out of 150, even in the worst period of mid cap, there were those 50 to 60 stocks which are growing about 20%. And if those stocks are also falling today because of the market correction, that is why I said in the initial part, reassess your portfolio, look at your portfolio, reduce the breadth of the portfolio, and reduce the rise cash wherever you feel the earnings growth is not happening and you're still stuck to the narrative. And I'm getting a lot of clients' portfolio today where it is a reality. 50% of the portfolio is in PSUs, because that's the one which rallied last year, and it's been correcting also. So you have to reassess. I'm not saying sell all the PSUs, but PSUs benefited from the momentum last year. So you have to reassess whether the valuation is right. So when we were saying okay, PSU utilities cannot be trading at 3 times price to book value, 4 times price to book value for a 10% ROC business. The market was not listening because market was looking one side, right? But now they will re-question all this over the next 2 year time period. So literally, if you are owning that part of the train, or if you are boarded that part of a train which is heading south, which for a moment you thought that it is heading north, please get down and then take the next train in the next platform, because they shift to the right side, and that will help you to, even within mid and small cap, to navigate this market. And these stocks, if they are correcting now, and if you're seeing the earnings is good if the earnings of those companies are good in Q3, then they should do something exceptionally wrong for them to go down further from here. When we are expecting that the earnings of the economy itself will be slightly going up from here, because Q3 was exceptionally lower, we might go back to Nifty large cap, might go back to a 8 to 10% sort of a growth. In that scenario, what you expect from companies which are already growing at 15-25%? So they should also be lifting another 4-5% from there. And if they have also corrected 25-30% on their valuations, I was seeing a lot of panic leads to opportunity. I'm not quoting any stock or recommending any stock here. I'm just giving a what is happening in the market can throw opportunity to you. All of us know there are companies within, if India's manufacturing story, if I'm not a big fan of India's becoming an export hub of the world and all, that's a very big call, and I think it happens very rarely. But within manufacturing, there are areas where definitely government is focusing to ensure that we domestically manufacture, not depend from or imported from other countries. If that were to happen, the demand for certain industries will still be very good, and they have a reasonable growth. And if I saw some negative news coming because some large companies investing into a particular sector, the stock corrected 20%. The valuation of this company used to be almost 40 times multiple 1 year forward, or even higher than that in the peak of the market, somewhere like 45-50 times multiple. Today, it is available at 25 times. The growth has not changed. The recent quarter was good for the company. The company's management, looking at what pipeline they have, they feel that 15% growth is minimum possible, and it is suddenly available at 25 times multiple. Now only the investor should not sit and think that, try to take this big call that market will totally correct, all stocks will fall. This you need to differentiate. You should start differentiating. And whenever there is a negative news today in the market, I think that is an opportunity rather than if there is a negative news about a stock in the market, which is not immediately going to affect the earnings, then it's an opportunity for you. And if particularly if it's a mid and small cap, the stock will have the ability to correct significantly for a very small sale in that counter. So those are the areas where the investor should pay attention, see the earnings, and then link the valuation and judge whether the growth can continue here for another 1 year or so. Those companies can deliver you return in a year time also, in my opinion. So just look at the market from a different perspective, different prism. The correction has been very steep. So I think further from here, if you think you want to raise cash to 100% to wait for another 10 to 15% correction, if you get it's lucky. I also will be very happy, right? I have 30% cash. If the market were to correct another 10%, I will be the happy person. But I think large part of the correction has happened very quickly. And suddenly we are seeing, okay, it's a good bargain we are getting. Whether we buy now or we happily buy another 10% correction in the stock, it's a call that we can take. But I will say, if I want to put 5% in that stock, I will say I will buy 1%, 2%, and then wait. I won't continue to stay too much away from the market. It's time that we start looking for those stocks, prepare a list of them, cut down all the stocks where you have a earnings issue, because they are not going to save you, because market's momentum to support low earnings growth, low PE stocks are gone. It will move towards, and it is like seeds you have to sow, and don't expect any return for at least 6 months. The seeds will show their capability only when the first rain comes. So wait for the first rain. The first time when there is a buying happens, you will see these companies coming back very strongly.
Great analogies, Madan. Your railway example was quite helpful in sort of visualizing where we are today. Let me get back to the answer that you gave for the previous question. You talked about manufacturing. You talked about how earnings has to be in focus. So if I were to sort of draw a little from that manufacturing example that you were giving us, what are the key themes that you are looking to focus on in 2025? Share your broad pointers as to what themes do you think will play in 2025 based on the earnings momentum you're sort of seeing on the ground. Sort of, if you can help us cut the noise a bit and help investors sort of focus on those sectors where you think are looking promising for 2025.
Thank you, sir. So the best way to approach when you're looking, when I said that we need to reassess the entire thought process, I think next 2-3 months market will continue to reassess it. It will take a direction only in the second half, in my opinion, probably. Direction in terms of which sectors to win. So your winners should be identified in the first half. They will deliver you returns in the second half. So I think that's how I see the market. That's how I want to play the game. And I think that will throw you opportunity to make alpha in the second half of this year. My sense is, I think if you look at wherever there has been a bit of a noise, negative noise, and those sectors have not performed last year, and they have fallen also in the last 2 months. But now those noise are turning positive. Then most probably your chances of losing money is very low in that. And because they have already not performed last year, they have also seen some correction in the last 2 months. And now the reason for which they did not perform last year was a cyclical issue. And then now that cycle is changing or that noise is reducing. I think those are blinders, in my opinion. You just have to go put some money in those. And within that, don't try to run behind cheap or low quality stocks with poor balance sheet, poor management, poor ROCE. So when I say quality, not quality, I just stick to 3 points. Poor management who says something, doesn't execute it. ROCE very low. It's a management which is not able to run a business which is above 13%, then it's not creating any value to you or neither to the economy. Third is the management has screwed the balance sheet, therefore the balance sheet is carrying a debt. And when the things are chaotic, you don't want to bet on a balance sheet which is already weak. So these are 3. So always choose the other guys who have a reasonable balance sheet, good management which has delivered in the past, and who have a reasonable ROC in the book. If the things will recover, the ROC will come back. So bet on those names. But wherever the sectors or themes where the noise is very high, those are, in my opinion, are the first leg of buying which should happen. Last years, if you see the sectors which have been always on the negative side and not contributed, one is NBFC. Because RBI was tightening, given some early signs of NPAs in certain segments, RBI started tightening lending norms to NBFCs last year. And then the noise on MFI came in. So it got further strengthened, that momentum got further strengthened. So throughout last 1 year, NBFCs went nowhere. So some of the NBFCs, if you look at the NBFCs which are well run, they actually grow much superior than banks. If the banks' balance sheets are growing at around 12 to 14%, even private banks I'm talking about, PSU banks grow at only 10%, less than that. But private banks generally grow between 12 to 14%. These NBFCs are capable of growing 25%, double the growth rate of banks. And some of these NBFCs have a good ROA also. Banks, best of the banks run a 2% ROA. PSUs have a 1% ROA. Some of these NBFCs deliver almost 3.5% plus ROA, or some of them are even 4% ROA. They can leverage, basically based on capital adequacy norms, they can leverage up to 6 to 7 times, depending upon the risk. So some of these companies will leverage only up to, say, 4 to 5 times. Some of them will move even up to 6 to 7 times. They can deliver you a 18-20% minimum ROE compounding on the book. And they were available at a reasonable bargain just 2 months back. Some of them have recovered, like a Bajaj Finance has already recovered. He's the best performer after so many years. Bajaj Finance after 3 years. We entered the stock last year, we could not make money. But first 2-3 months of this year, we have made significant money because Bajaj Finance has given 30% return when the market has fallen 7% in the last 3 months. Chola, same thing has happened. Chola has given almost 25% return in a period when market is corrected, almost like. I still think there is a lot of gap to fill in the NBFC space because government has just relaxed these norms last week. They are now becoming accommodative. They are sensing that the problem is not as big as what they probably envisaged. While in MFI space there is still noise, but please understand, you will make money in banking only when you fish into troubled waters. Otherwise, banking is a boring sector. You don't need rocket science to understand banking. When there is trouble, and if the trouble is solvable within say 2 to 3 quarter time period, then they keep on giving you huge opportunity in terms of making money. Therefore, I feel that these issues which are surrounding the MFI and unsecured loans and all this stuff, which will go away in next 2 quarters time, and anybody who buys and holds it for a year will make a reasonable amount of money. So this is one space we think even people who want some money to be made in the first leg of interest in India. I think these are sectors which will participate in a big way, in my opinion. I don't think economy is weakening too much for you to worry about the credit cycle in retail. Retail, the credit cycle has never been long term. It's been like maximum, I think it's a year, but mostly it gets addressed because the book itself gets refinanced within a year's time. If you take MFI, the book itself gets refinanced in a year to 1.5 years time period. So we are already almost a year into it. So most of the book would have been refinanced now. So within that, some really good attractive opportunities are there, and valuations are also at a reasonable price. Therefore, you should be picking some of the stocks, and those stocks have also fallen in the recent correction, and you are getting them at a reasonable valuation, and the noise is now coming down. And these are well-managed businesses. They are not poorly managed businesses. Consumer discretionary, given all the effort that government is taking, now that the expectation, and when I refer about consumer discretionary, I only refer to the urban consumption. There are two Indias, right, in India. Within India, there are two Indias. The South and West have a very high per capita income, and the East and North Northeast sort of as a very low per capita income. So anything that has, any business that has done well, like NBFCs from South has done well, even West has done well. Same way, consumption companies which are focused on this part of the countries have done well because the consumption here has been very strong in terms of discretionary spending. This sector has also not done well last year. I would say the reason for that is people say inflation, job market was not as bad as what people think. It was not great, but it is not bad. It was not declining. People are not losing job. So there was a single digit growth. So there is no need for job to impact. But you saw 4 lakh crore money coming in SIPs, right? So it's somebody saving which is getting into investment. So I feel to some extent discretionary spending would have got little cut down because of people's intention to save. Now government is giving a taxation benefit. Market is seeing some bit of a volatility, so people will shift some of their SIPs out, or those reallocation might happen. So it's a period where consumption should come back, and the government is cutting the repo rate also. So we should feel closer to the festive, you should see some improvement in the consumption also. So that's another space where people have to pay attention to, in my opinion, in terms of sectoral themes. Power within infrastructure is looking amazingly strong. This is not a short-term blip like what happens in infrastructure. Every time it gives a very high hope and then doesn't deliver. Because power is a long-term story, long cycle. Projects take 4-5 years to come, and we made a mistake of not investing it during COVID period. Now we are understanding it and we are investing into it. Therefore, it won't stop. It's not like a start and stop. You give orders take 2-3 years, and then the execution stops. If we don't address this problem now, you can see globally also there is a power shortage. There is a report that has been published which says that data centers alone need 60 gigawatt of power in next 7 years, and only 10 gigawatt is under construction. The remaining 50 gigawatt has to come from small nuclear reactors or small gas turbines or even fuel cells based electricity generation. These new technologies are all being looked upon to solve this problem, because America did not invest in power sector infrastructure for so many years now. India also did the same mistake during the COVID period. And therefore, now we are suddenly looking at a scenario where power demand, if it grows even 6-7% next year, we might have a power cut scenario sometime later. So we will go through this power sector investment. It is still in the early stage. I think those stocks have also fallen. And the order book of some of these companies in power transmission and distribution, and even BHL, it's a stock which I used to have a negative view for so many years, you must be knowing, because we have discussed so many times about this. But it looks very attractive because they are selling all the PSUs, they are selling BHL also. But BHL's order book is very different today compared to what it was 2-3 years back. And today there is no Chinese competition, whether it is in generation or whether there is transmission distribution, because Chinese competition is to kill the margins. So now these companies are able to ask for margin and their ROC is very good. So these businesses should not be correcting so fast like what others are happening. So within infra, I think you should sell all the infra stocks and put it in power. I think this correction is giving you a good entry opportunity. So these are 4-5 themes that we are playing, and we think the recent correction is giving a good opportunity for any investor who wants to get in and buy into those companies. Some of these ideas which I talked about, we also own, but obviously you cannot get in and expect that you make immediate return. I think if you get into these themes with a 1-year view, I think some good reasonable alpha can be created. If you give a 2-year view, irrespective of the market, a reasonable return can be made, in our opinion.
Wonderful, Madan. That was really, really detailed and very useful for us. So 3 quick takeaways that I can take from an investor's point of view is: look at good businesses, look at good balance sheets, and look at ROC that is more than 12%, is what broadly that I understand 3 pointers that you were telling investors. So I think that was a lovely, lovely conversation, Madan. I think we can open it for Q&A. Akshara, if that will be great, if we can do that.
Before we open it for Q&A, I have one question to Arjun. It's always Arjun who keeps asking question like in Mahabharata, no? So I also want to ask him one question. So what is your opinion, Arjun? What do you think economy is heading to? Is my call that some of the reflationary efforts that government is taking will pan out well, and we will head north again, and the economy will come back to grow stronger growth numbers?
Sure. So I'll just give a very quick answer. So one headwind that we had actually seen over the last couple of quarters was capex. I think you also alluded to that. So the September quarter numbers, I think anytime now you should be seeing your India GDP numbers for the December quarter coming out. It's very likely that it has to be north of 6%. Except it should sort of tell us that the September quarter numbers was a bottom out that was actually the worst is behind us, because you have the capex momentum that really was not there in the first and the second quarter picked up very sharply in the month of December, and it is underway as we speak. So that is going to give you one positive boost. Second, on the rate cut narrative, that's going to give you another positive boost. So directionally, I think we are looking up. The worst seems to be behind us. Two small areas that I feel everybody should be closely watching. One is the currency, because your FII inflows, if that does not see a sharp pickup, it can see some sort of an impact on the currency. Some catch-up depreciation is a possibility. But one very important variable I think people have to very closely track is crude prices. So from the day Donald Trump, the president of the United States, took power, all the executive orders that he's been talking about has been, so Donald Trump, his Treasury Secretary, his Energy Secretary, all of them are talking about more crude production at a point in time when demand for crude is not very strong, is sort of muted. So US is the largest producer of the world of crude oil and is around third, the fourth largest exporter as well. So any small delta on the supply side can give you a positive boost on crude. And if crude comes off even around $10-15 a barrel, I think for India and emerging markets as a whole, it can be a very big support and a very big positive. So I think those are the only two key variables I'm very closely tracking. One is currency, and second is the crude prices. As economy, I think we're doing fairly okay. We've been holding up even during bad times. So things are much better now. The RBI dispensation that you were talking about, the rate cut narrative, and risk weights coming off, I think these two are very significant positives directionally as well. So I think I'll stop there. I don't want to take limelight from you.
Thank you. Thank you.